I think we're all hoping for a quiet summer's morning. From New York City this morning, good morning, good morning. Your equity market slightly negative on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York coming up, Fed officials unwilling to declare victory, Secretary Yellen leading the Bidenomics PR tour, and China attempting to stabilize financial markets. We begin with the big issue, too much of a good thing.
This resilient economic backdrop.
Resilient.
Very, very resilient.
The economy surprised to the upside.
Labor market in the U.S. has held up pretty well.
Labor markets are tight.
There's more money in household pockets.
Inflation has been falling, pretty notably.
It removes a sense of urgency for the Fed to normalize policy quickly.
The Fed will have to be more aggressive, raising rates higher and keeping rates higher for longer.
Interest rates are going to stay higher for longer.
Higher for longer.
We are not certain that the last hike is behind us.
One more hike, that's likely.
Does this resilient economic backdrop leave the Fed in a position where the bar for rate cuts is very high?
I think we'll have to watch out how the data play out.
Try to take advantage when bad news becomes bad news.
There are reasons to be concerned.
A downturn potentially and eventually will come.
It's premature then for FOMC members to go out and already talk about cutting interest rates.
The soft landing scenario is the worst case scenario.
Joining us now to discuss exactly that, Morgan Stanley's Brian Weinstein, Sarah Hunt of Alpine Saxon Woods. To the two of you, thank you. Sarah, first to you. Is there such thing as too much of a good thing?
Well, it's really interesting how fast the narrative has changed from a soft landing is going to be great to, oh my goodness, a soft landing means we have to keep rates higher for longer. And then all of a sudden we start running into these things like the maturity wall and concerns about interest rate payments. I think there's been a lot of expectation that the Fed would cut rates after a short period of time, and therefore you didn't have to worry so much about higher rates and it would be okay and housing can go back to, mortgages can come down. I think that there is too much of a good thing right now, and I think that that's starting to concern people.
Sarah, you and I have talked about this a million times. We've gone from soft landing to no landing to hard landing to soft. Brian Weinstein, where on earth are we now in August?
You know, John, you said everyone wanted a quiet summer. I think the market's being indecisive here, right? We're settling into a range. We're trying to find out where interest rates are going to go. We tested 3.3% early in the year. I don't think we found the high end of the range in interest rates, but I think the market is basically saying exactly what you guys just were going over, that where this looks like a soft landing, it's not too much of a good thing yet. We just want to, we're okay here, right? A 4.25 10-year note is not really hurting anybody, and the equity market seems perfectly happy hanging out around these levels.
Brian, not much of a landing at all. Rates are through 5%, unemployment at 3.5%, CPI is above target, retail sales, massive upside surprise in the last 24 hours. What landing do you see?
Yeah, again, there's no landing in sight. Although, Jonathan, let's be honest. If you look under the hood, default rates are picking up in corporate America, right? If you look at the high yield market, the loan market, you know, the Fed raising rates is just starting to bite. So, while it looks like no landing now, I think on a forward basis, there are not terrible things happening, but this looks like a real business cycle. There are winners, there are losers, and you have to be careful where you invest. It's going to get harder from here, not easier.
Sarah, is the underlying growth story that you expect to develop in the next several months, next several quarters, is the unemployment rate, the labour market with unemployment at 3.5% consistent with heading back to 2% anytime soon?
I think that's going to be very tricky. And I think you've also started to see some of those commodity prices add to the inflation picture. Just as we thought inflation was just coming down and it was going to go in one direction, I think you might see some inflation uptick on that. And it's not just about energy prices in terms of gasoline. It's also about how that impacts the whole input cost chain. So I think that the desire of inflation directly down without any bumps in the road is also going to be the sticky one for the Fed. And I think it's going to be, I love the comment that it raises the bar very high for a Fed rate cut. I think that's going to be the tricky part going forward.
It's a tricky debate going into Jackson Hole, about a week away, the annual Fed Reserve get together. Plenty of Fed speakers speaking over the last week. We've heard from Neil Kashkari. Take a listen to what Neil had to say.
Are we done raising rates? I'm not ready to say that we're done. In terms of cutting rates, I think we're a long way away from cutting rates because core inflation is still around 4%. It's still around twice of what our target is.
We've got work to do. Matt Boesler joins us now from Bloomberg. Matt, it's been far too long, a week away from Jackson Hole. Matt, what do you think is on the agenda for the Federal Reserve and Chairman Powell and the team?
Yeah, so the big question is how big these two relative camps on the FOMC are right now in terms of people who think they're done raising rates and people who think maybe they still have a little bit more to do, like Neil Kashkari was indicating. And we'll get a bit of a clue from that, probably from the minutes of the July FOMC meeting that are coming out later this afternoon. We're hoping to see, if they kind of flesh out some of the Fed speak that we've gotten since the July meeting. We've got some people like Philly Fed President Pat Harker saying, maybe we're done. We can probably hold here. We've got other people like Kashkari and San Francisco Fed President Mary Daly, Fed Governor Michelle Bowman saying we probably have more hikes to do. So I think that's kind of the big question for today and going into next week.
Matt, there's some splintering on the committee. Given that splintering, Chairman Powell's in a difficult position to really reflect a consensus that does not exist. When you have to make a call right now, what do you think the chairman wants to communicate? 12 months ago, it was easy. Inflation's too high. Need to get it down. Need to be aggressive. What do you think the message needs to be now?
Well, I think the message is, that they are not done, right? Their inflation is still too high. We've heard that pretty uniformly from Fed officials across the spectrum. And so there's going to be that, ongoing commitment to bringing inflation down. But I think we're starting to shift a little bit more toward, how long are we going to hold rates at peak levels versus are we going to keep raising them from here? And so, when you look at the projections from Fed officials, they show rate cuts at some point next year, but we don't really get a sense of when they start because, of course, those projections are labeled for the end of each year. And so I think that kind of question of when do those rate cuts start commencing, and then also how much do we get in terms of rate cuts next year, those are going to be kind of the big debates going forward. And maybe we'll get a little bit of a tease from Powell next week at Jackson Hole on that question.
Hey, Matt, thank you. Come back soon. Matt Boesler there, one of the best on the Federal Reserve here at Bloomberg. The whole of the team just fantastic going into next week. Brian Weinstein, this Federal Reserve, do you think based on market pricing right now there is room to reappraise policy pricing more hawkishly than we have over the last few weeks?
No, I really don't think so. I think there's more of a consensus than it sounds. I mean, the Fed needs to sound steadfast on inflation. They are. They want to keep rates higher for longer, but they don't want to go anymore, tinker with 25 basis points again just to say they did something. I think they believe they've done a lot. They want time. They need a lot more information. We're not one CPI print away or one unemployment print away from their changing their minds. So I think they want to stay here, and I think they want to say very little. Just keep saying what they're saying and let the market sort it out, and then they can tell over the next 6 months how much impact their rate cuts, their rate hikes have had before they discuss anything else.
Brian, this bond market's done a lot over the last month, including the last 4 days. We're back through 420, unchanged on the session. Previous 4 days, it's been a move of like 20 basis points, Brian. There's some notes that I've got from you, and there's this line that jumps out to me. Beware of duration, the long end is not cheap. Is 420 not cheap on a 10-year?
No, I don't think so. I don't think we're there yet, Jonathan. Like, listen, you come into the year at 390. You expect about 100 basis point range on average. So we did the 60 down. We've done 30, 40 up. We're close, and I think we can settle into a range here. But I don't think we're trading 330 to 420. I think you have to think about a range of maybe 390 being the low end now, and I don't think we found the upper end yet. I think inflation is sticky. Investors need some risk premium in there. A lot of supply coming. A lot of lack of foreign demand. I think rates are going higher than here, though the quick part of the move has happened. It'll be more difficult, orderly, and a bit more slow, but I think we're going higher.
Sarah, do you agree?
Yes, I do. And I think that that's exactly part of the problem, right? And what Brian just said was excellent in terms of timing. The Fed needs more time. Wall Street people and market people are so used to having instantaneous information. Prices change so quickly, and we can see the effects of earnings coming out on a stock or something else. Those moves on interest rates in the economy take a lot longer to flow through. And I think that feeling has been, well, they haven't flown through by now, so they're not going to flow through. And I think that's really the problem. And if you look at where the market's pricing out rate cuts to start, I think that if you have to wait 6 months, we can't possibly start rate cuts in that interim unless something really bad happens. So I think that the tension there is higher rates for longer, which has been sort of the drumbeat of the last week or two.
There's a tension there in the credit market too. Sarah, you mentioned it about 5 minutes ago. You talked about the maturity wall on the horizon. If you're both right, if this Fed is not cutting anytime soon, if you're both in the camp where we're going to be higher for longer, then at some point, Sarah, credit spreads at 375 on high yield don't make sense, do they?
No, because I think a lot of people, unlike the U.S. government, which I've said before, termed out their debt. And they've been waiting to see, okay, so rate cuts are going to come. I termed out my debt. I don't have to worry about any short-term maturities. As rates stay higher for longer, that starts to change. And if I've got to refinance debt, that's going to bring my cost structure up. If my cost structure goes up, what am I going to do? I'm worried about my margins. So then you start to get into more layoffs. I think that companies were so scarred by the pandemic and not being able to get labor back that they've been much more sticky about keeping labor longer. But if the other input costs start to come up, I don't see how they can continue to do that.
Brian, final word on that.
No, I think that's right. I mean, you look at high yield spreads and go, I don't love them here, but look at the yields, right? So you have a lot of cushion. There are going to be defaults. There are going to be increasing defaults. I don't think you want to own just the index. You have to choose which bonds you own. So there will be a credit cycle. Things will get more difficult. Higher rates will put pressure on companies, but it'll also bring in investors. So higher default rates, but I still think you can have decent performance as credit spreads widen from here.
Brian Weinstein. Sarah Hunt, you're going to stick with us. We've got more to talk about, including the latest over in China. Tons to talk about in China after the rate cut earlier this week, which felt like a lifetime ago, didn't it? The data's been pretty weak as well. And then there's some tweaks to policy we need to discuss too. Equities right now negative on the S&P 500 with some movers. Here's Abby.
Let's start out with the shares of Target, John, because they are absolutely soaring. And this after the company put up a huge profit beat, 300% above what they put up a year ago, but also beating estimates. The stock up 6.1%. And it's one of those rare times when the quarter that was reported takes precedence over the outlook, because they actually are sort of cautious on the future. But relative to that big earnings beat, it had everything to do with pairing bloated inventories. Coinbase up 4.5%. They've won approval to start hosting crypto futures in the U.S. and operating a futures commission merchant exchange. And then Coherent, the semiconductor company, well, they offered a weak forecast. They're saying that it's a reset year plus macro headwinds. That stock absolutely plunging.
Abby, thank you. More from Abby around the opening bell. Coming up, China looking to support fragile markets.
We're pretty cautious on China. The sentiment issue, frankly, is what's going to keep people out a little bit. You know, foreign investors, I think we're not happy with how they were treated by China over the last couple of years.
That conversation coming up next, about 20 minutes out from the opening bell. Equities just a little bit lower. Good morning.
We're pretty cautious on China. The sentiment issue, frankly, is what's going to keep people out a little bit. You know, foreign investors, I think we're not happy with how they were treated by China over the last couple of years. If you look at the foreign direct investment in China, it's come off a little bit. U.S. companies are clearly not putting money, directly in there.
That was Citi Stuart Kaiser discussing his investment strategy for China. This as the disappointing data continues, weighing on market sentiment and leading several banks to downgrade their growth forecasts. Policymakers stepping up their support. According to people familiar with the matter, attempting to stabilise financial markets by asking some investment funds to avoid being net sellers of equities. Tom Ehrlich joins us now for more down in Washington. Tom, let's start here. Just the policy shift. What are we hearing about what they're doing now?
So there's been a flurry of moves overnight, Jonathan. We've had that request from the securities regulator that you mentioned, asking funds not to be net sellers in the market. We've also had the PBOC amping up liquidity injections and providing some firm guidance to the currency market, aiming to stem the depreciation of the renminbi. What does it add up to? Well, so far, I think we're still looking at micro moves. There's nothing here which adds up to the kind of big bang which the markets are looking for in order to turn sentiment around.
What does it mean for us, Tom, is a question you and I have been exploring. You wrote, together with the team yesterday, Powell's new problem may be made in China. Tom, some people have pushed back against that, made the argument we're somehow insulated, the Fed won't be setting policy for what happens over there. What would you say back to that, Tom?
So if we go back in the history books, Jonathan, it's not that hard to find examples of moments where China did move the dial for the Fed. Think about the end of 2015, where we had equity markets collapsing, the yuan collapsing, and that was enough to put the Fed on hold and knock a bunch of rate hikes off the agenda. What would it take for that to happen again? What would it take for China to push the Fed from what we think is going to be an extended pause from here into earlier than expected rate cuts? Well, I think we would certainly need to see a significant deterioration in the situation in China from where we are now. And we'd also have to see that sparking a global risk-off trade. That's what happened in 2015, and it was that global risk-off sentiment, that global tightening in credit conditions, which changed the trajectory for the Fed. We're not there yet, but with one of China's biggest property developers on the cusp of default, with protesters lining up outside one of China's biggest trust companies asking what's happened to their investments, and with the policy response from China's decision makers so far a little bit missing in action, clearly the risk is there.
There are things we need to think about. Tom, phenomenal work as always. Tom Orlik there of Bloomberg Economics. Poor data, weak data out of China, decent data stateside again. Upside surprise, industrial production month over month, 1%. The estimate 0.3. Manufacturing production 0.5%. The estimate flat, 0. It's a strong beat. Sarah Hunt, Brian Weinstein, back with us for more. Sarah, let's talk about China briefly. This is what we're reporting this morning. The authorities have asked some investment funds this week in China to avoid being so-called net sellers of equities. Does that instill any confidence in you, Sarah, to start buying?
That's a very difficult situation right now. And I think, this is not quite the outright ban on short selling that they tried a few years ago as well. But I think it speaks to the fact that you have this huge economy that is supposed to be part of the driver of the global economy as it's coming out of the pandemic. And you're starting to see some real problems there, and the kind of problems that we saw, quite frankly, globally in the 2007, 2008 timeframe. So the fact that they're having these big problems with both paying back from the trust company and a large real estate developer having big significant financial problems does not bode well for their demand for the commodities and for other goods outside of what they usually buy. That is a big driver of global growth. So I think that the problem is manyfold. It's not as bad as it was for globally in 2009 because you don't have as much interlinked in China with the rest of the world because of the capital control system. But I think it's still a problem.
Brian, how much more negative can it get just in terms of investor sentiment? I can't find anyone that speaks constructively about what's happening over there.
No, I think that's right. And we all know that, that China can stimulate when and if they want to and in size, right? So they have some structural issues. They're trying to work through them. People are bearish. It's in the price. The 10-year note in China's 2.6%, which is pretty low if you think there's any growth and inflation in the future. John, I think one thing to worry about is if the Chinese do stimulate in a significant way, and that does stoke inflation, it makes the Fed's job really difficult. And it's, I think, one of those reasons why when you see some of this Chinese news, you're not getting rallies in the back end of the U.S. yield curve, right? If you get more stimulus in the system, it's really not a great time for the Fed, and it probably pushes global inflation back up at a time where growth is falling. So we're just at a tough juncture in the markets, and so everyone has to be careful how and when they stimulate in an inflationary world.
So, Brian, glass half full or half empty? Should I be happy they're exporting disinflation, or unhappy that the growth profile is leading to disinflation?
Listen, I think the world needs China to grow, right? And we see weakness in parts of Europe too. So I think people will throw out the term stagflation, which I'm not sure is exactly right. But if you have growth slowing around the world, that's problematic here, and you want China to pick back up. I think that's the bigger deal. Work
with me here, Brian. I just want to draw your attention to what's happening in the FX market. Dollar yen 145.85. Very briefly, just breaching that 145.90 level. Those of you who remember back in September, that intervention into the FX market, these were the levels. We're back close to them, just briefly breached in, came back down. Brian, never mind China, let's talk about the BOJ. Growth strong, inflation's hot for Japan standards over the last few decades, and they're still trying to control the yield curve. Do you think that's possible?
Not for too much longer, right? You're seeing it. The markets are testing policymakers, whether it's re-steepening higher yields in the U.S. or going after the yen or the 10-year peg, forcing the Bank of Japan to move it. The data there is incredibly hot. It's very hard to imagine you can keep rates here and the currency under control. You can intervene temporarily, but again, another reason to think rates can go higher globally is that market something is going to give.
Sarah, there's a feeling that it's their problem and not ours. That Japan has issues we don't have to worry about. That China has issues, they're not our problem. Do you share that view?
You can't really share that view. I mean, the entire global economy financially is very much interlinked. And even though China is a little bit outside of that just because of the way that they control their own capital, what happens in Japan does matter. There's huge holders of treasuries outside of the U.S. And the global market problems become our problems as well, as things are sold because they have to, not because people want to. So I think that you can't isolate yourselves. And I think that it is an issue for the U.S. markets. And I agree with Brian, it's also an issue for the Fed.
Sarah Hunt. Brian Weinstein, to the two of you, thank you. Breaking down a lot of complex issues right now worldwide, not just stateside. Equities on the S&P 500, negative by 0.2% on the S&P. Your update on the bond market, yields are just a little bit lower through most of this morning, though inflecting higher off the back of that industrial production number. Your 2-year still down by a basis point or so at about 493, after breaching 5% in yesterday's session for the first time since early July. Just very briefly, your new high for the year, by the way, on a 10-year, very, very close to 427 in yesterday's session, and we backed away as well from there. In the FX market, the one to watch, I mentioned it briefly, dollar yen just breaking out a touch, positive by a couple of tenths of 1%, and very briefly through 145.90, the kind of level that triggered some intervention last time around. At the moment, 145.85. Coming up on this programme, the morning calls, and later, Target topping Q2 earnings estimates. The stock up by 7.52% in the pre-market. The opening bell about 7 or 8 minutes away. The conversation still ahead with CFRA's Arun Sundaram. Five minutes away from the opening bell, looking at a second day of losses potentially here, with the S&P 500 negative by just 0.2% going into the cash open. That's the equity story. Let's get you some morning calls. First up, Piper Sandler raising its Nvidia price target to 500, expecting the company to deliver better than estimated results next week. That stock is positive by 0.9%. in the pre-market. Your second call from Mizuho, upgrading Chevron to buy, 209 price target, pointing to secular tailwinds and improving margins. That stock positive too, 160.30 in early trading and positive by 0.7%. And your third and final call from the team at UBS, upgrading Keurig Dr Pepper to buy, highlighting the stock's attractive valuation and what they call strengthening earnings power. Their stock is up by, let's call it 1.9% to $34 at about 10 cents. Coming up on this program, Target a curious one, crushing profit estimates, but a miss on the top line, a beat on the bottom line, and the outlook get cuts as well. But look at the stock, up by 7.6% in early trading. A conversation with CFRA's Arun Sundaram coming up shortly. Your opening bell just around the corner. The story of the week so far, what Monday gave, Tuesday took away. Just about negative on the week at the moment, and we add to it. We take more away by about 1/10% on the S&P 500. If we closed here right now, early days I know, the week is still young, but if we did on the S&P 500, third week of losses, longest weekly losing streak of the year so far. We'll see about that. There's your opening bell. Switch on the board and get to the bond market. What a move we've seen over the last 4 days. Yields higher, yields higher, yields higher, yields higher. Let's see if we make it day 5 on a 10-year. 4.2228, yields up by a single basis point. The data in the last 15 minutes, manufacturing, industrial production, pretty decent. Upside surprise. In the FX market, the euro hanging on to 109, 109.10, and crude positive by 0.2%, $81 and about 15 cents. The one stock to watch at the open, it's Target. Better than expected Q2 profits, overshadowing the retailer's increasingly cautious outlook. The CEO saying this: the consumer is still challenged by the levels of inflation that they're seeing in household essentials. That's absorbing a much bigger portion of their budget. Abby has more. Hey, Abby.
Hey, John. Well, investors are really liking this quarter right now because this stock is up more than 8%, heading to its best day since March of 2022. And this stock has really been lagging its peers into today, down 16% on the year. Well, it's really had that now, down less less than 10% on the year. Now, it's also a very rare instance where investors are paying much more attention to the quarter that was as opposed to the guidance, because the guidance for the year, a range of $7 to $8 for profits, that's a little bit light relative to where analysts were, and it's 75 cents shy of where the company had been. As for the profit, though, this is a big story. They put up $1.80 in adjusted earnings in the July quarter. That is more than 300% better than what they did last year when they put up 44 cents. The interesting point, though, that you were making earlier, revenue is a little bit light, and that has to do with some of that weakness that Brian Cornell is talking about with the consumer, although it looks like the trend is a little bit better in August based on some of the comments they're making. Again, this stock up in a big way. Investors liking what they're seeing out of Target as it has, again, lagged on the year. Maybe a little bit of a catch-up trade here, John.
Abby, thank you. About up almost 7%, about 2 minutes into the session. Let's stick with retail. TJX topping earnings estimates and boosting the outlook, getting a lift from customers searching for cheaper alternatives. The CEO saying, I want to recognize the execution of our teams, focusing on bringing customers excellent values and an exciting treasure hunt shopping experience. The third quarter is off to a very strong start. Simone has more. Hey, Simone.
Hey, John. Yeah, the rationale for the enthusiasm we're seeing in these shares a little bit more obvious than the Target story. Again, TJX, the parent of TJ Maxx, Marshalls, Home Goods. Overall comp sales in the second quarter up 6% year on year. The estimate was for about half that. EPS 85 cents versus 69 cents that analysts were looking for, and therefore the company raising its full year guidance, now seeing sales up 3 to 4%, previously looking for 2 to 3%, and for what it's worth, the street was looking at 3% for the year. Of particular importance to analysts is Home Goods. Citi said that they were looking for an inflection point here with home spending relatively light, and they saw one. Comp sales up 4%, expected to actually decline slightly. A very optimistic note from CEO Ernie Herrmann. Perhaps the reason we're not seeing shares move even higher is the fact that this looks like they're set for a record close today if they hold this level.
You raise your guidance, you're rewarded with a 3% rally. You cut your guidance and you get a 6-7% rally. The story of the retailers this morning. Simone, thank you. Levels matter, valuations, of course, past performance, all of that. I know. It's just a joke. 3 minutes into the session, equities negative here by 0.1% on the S&P. On the Nasdaq, we're negative here by 0.4. Let's turn to the utility sector. Hawaiian Electric trying to rebound amid growing questions over whether its power equipment may have been a source of the wildfires in Maui. Analysts at Guggenheim writing this. Here's the quote. Given the size of the company, I don't know how they would be able to account for this if they are found negligent. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, shares were trying to rebound. They were up over 3% in the pre-market trading. But now, as the bell rings, you can see Hawaiian Electric down 2%. If this holds, this would be a 7th straight day of declines, of course, with the company's future in doubt. For context, Hawaiian Electric supplies roughly 95% of Hawaii's residents with power. And like you mentioned, questions growing here over whether it's the company's power equipment that's the source of the Maui wildfires. And Wall Street isn't necessarily waiting to find out. Hawaiian Electric has shed $1.8 billion in market cap just over the past week. Shares closed at their lowest level since 2009 yesterday. And of course, analysts have been cutting their price targets on Hawaiian Electric in a hurry. And just yesterday, actually, S&P also downgraded Hawaiian Electric to junk status. There's no real news yet this morning, John, but you can see the shares wavering right now, currently in the red.
To your point, Katie, investors aren't waiting. That's half the market cap gone in just 3 days or so. Katie, thank you. Finally, just shares of Tesla under pressure just a touch again. The company cutting prices in China for the second time in 3 days, lowering the cost of its Model S and Model X vehicles and fueling concerns of a price war. Ed, the second time in 3 days. What's happening?
Yeah. There's so much to discuss here. First off, Tesla's down 1.5%. It's lower for a 4th consecutive day. It's the second run of 4 straight days of declines in the month of August. And I think crucially, it's worth noting that the stock is down more than 20% since the July 19th earnings call, where Elon Musk said that further price cuts are completely possible. The news overnight is that in China, Model S and Model X got a trim of almost $10,000 following the trims of $1,900 to the higher end Model Ys Monday. You will remember we discussed 24 hours ago that here in the US, Tesla had introduced a new base price for the latest generation of Model S and X, the net effect of which is to lower prices. So this is a lever Tesla uses. I reiterate, Elon Musk and other Tesla executives have said time and again that they're willing to sacrifice margin in the bottom line in order to protect the growth rate. I just want to point out very quick, John, a piece on the Bloomberg that just published from our global car editor, Craig Trudell. Because, of course, 24 hours ago, we were talking about how the PBOC had cut that key interest rate by the most since 2020. So because Elon Musk has put a lot of emphasis on rates, not just in the United States, but China is an incredibly important market for Tesla and other EV makers. So I never thought I'd be on this show talking about Musk, Tesla, and saying PBOC and key interest rate, but it's a core part of the story.
I didn't think I'd talk about Musk, Tesla, Zuckerberg, and mixed martial arts, Ed, but we have to do that these days too. Are we done talking about that, Ed? Is that conversation finished?
The latest is that Musk has posted to X a recap of the story, saying essentially when he challenged Zuckerberg in June, it was a joke. Zuckerberg came back with an acceptance, but then declined to follow up on it. I think we just leave it for the time being, John.
Good to know. The whole thing's become a joke. Ed, thank you, sir. Tesla here. Down just a little bit. No drama here. We're negative by 0.6%. Let's turn back to Target. Big move here. CFRA's Arun Sundaram reacting to the numbers, writing, quote, "This was the definition of mixed results. We saw a huge bottom line beat, but sales fell well below expectations. We think it is unlikely Target will return to its historical 6% plus operating margin over the next few years." He maintains a hold rating, a 135 price target. Arun, I'm pleased to say, joins us right now. Arun, let's start there. I know what the market's focused on. It's this second quarter profit rebound, this beat. Do you think we need to focus on the other stuff?
Yeah, no, I mean, I think what drives Target shares really is the bottom line. It's margins. That's the number one driver, I think, for Target shares. And this year, we're probably going to see operating margins around 4.5%, which is well below its historical range of 6 to 7%. And now, given the cut in the guidance this today, I think it's unlikely that Target will return to that 6% operating margin, certainly this year or even next year. Next year, it's more likely that Target's going to approach operating margins around 5%. So still well below its historical number.
Are things getting better? You know this company inside out. The headwinds to margins over the last year or so. Arun, do you see any improvement anywhere?
Yeah, no, I think that what the bulls will be pointing to this quarter is the really strong gross margins and disciplined cost management. We saw gross margins, significantly recovered from the prior year, but prior year was an outlier given all the inventory actions the company had to take. We also saw pretty good, operating expense discipline as well. Operating expenses grew less than we expected, and I think Target's doing well cutting costs. But unfortunately, like when you cut the top line, when you cut comp sales trends, you're going to face operating deleverage, and that's going to have an impact on overall margins. I think that's the big headwind right now. But the good news is that once comp sales trends do turn around, whenever that is, we should see some pretty significant operating margin improvement.
One word that we've all become familiar with, a word you know well, following the company, shrink, otherwise known as theft. Has that got better, Arun? Has it stopped getting worse?
Target said on the earnings call today that it may be plateauing, but that doesn't necessarily mean it's a good thing because that still means things are really bad. They're still seeing theft and organized crime. In fact, they did say today that, year to date, they've seen a 120% increase in theft incidents involving violence or threats of violence. So it's still a problem. Shrink's going to be an issue the rest of this year. In terms of the fundamentals or the financials, comps do get easier by Q4 this year, specifically on the shrink number, because if you recall, last year around Q4 is when shrink became a bigger issue. So the comps do get a little bit easier, but it doesn't look like things are that much better than a few months ago or a few quarters ago.
They've had a tough go of it, as you know, and not just because of this issue, but also they've found it difficult to keep progressive customers happy and conservative customers happy at the same time. Arun, what's happening on that front, and what have they said about it now?
Yeah, I mean, they clearly made a mistake with their Pride merchandising and marketing, and that had a material impact in the quarter. They said that comp sales trends really started to soften in the second half of May, and that continued in June, which is around the time when the Pride merchandise backlash fell. But once they did pull that merchandise in June, Target did see a meaningful recovery in traffic and comp sales trends in July, and that kind of continued into August. So that's another reason why the shares might be up today. But it remains to be seen if this is going to be a longer term issue or not. It's clearly these days you have to be really careful of how you market, how you brand. Historically, these boycotts usually didn't amount to much, but times are different these days. Companies like Bud Light, for example, is clearly facing some issues there. I think between social media, the media, just polarizing views, you just have to be really careful how you market and brand. And clearly, Target, learned a lesson with this Pride merchandise.
An expensive one. It's a difficult moment to run a company, that's for sure. Arun, thank you, sir, for the update on Target there. Arun Sundaram there on the latest. Target, the stock is up in early trading about 11 minutes into the session. The equity market's positive too by 0.15%. Coming up on this program, the Bidenomics PR tour continues.
Wages are growing faster than inflation. Folks, that's Bidenomics.
The White House pushing Bidenomics as President Biden prepares to deliver remarks from the White House. The conversation up next.
I came to office determined to move away from the trickle-down economics. The Financial Times and the Wall Street Journal started calling my plan not initially as a compliment to Bidenomics. But guess what, folks? They're talking about it differently now. It's working. Because we're investing in America. According to Morgan Stanley and Goldman Sachs, my plan is leading to a boom. They call it a boom in manufacturing. Wages are growing faster than inflation. Folks, that's Bidenomics.
Everyone loves investment banks when investment banks say nice things about you. When politicians typically talk about investment banks, they haven't got nice things to say. President Biden speaking on the anniversary of the Inflation Reduction Act. Secretary Yellen writing in the Wall Street Journal today, with the Inflation Reduction Act, we're delivering on what I call modern supply-side economics. It's a turning point in the national effort to preserve the planet and to shape a prosperous, inclusive and resilient economic future. For the second time this morning, we can say good morning and welcome back to Bloomberg's Anne-Marie. AMH, what's the latest on this PR push?
Good morning, John. Well, it is a PR push from the administration because while they want to tout Bidenomics and they want to make sure the message is getting across from the Inflation Reduction Act, which was signed into law a year ago today, which is tens of billions of dollars going to clean energy initiatives, it is not landing in terms of political success. When you look at some recent polls, CNN, a majority of individuals in America still think the economy is doing very poorly. And then when you look at this specific bill, which the administration has really been trying to tout, a blitz across the entire nation, whether it's Biden or some of his other surrogates, touting what this bill does. 7 in 10 Americans, according to the Washington Post and University of Maryland survey released earlier this month, say they have heard little or nothing about the law. So that's really the struggle the president is trying to make because, of course, he is going to be the contender for the November 2024 election.
We'll get the Republican definition of all of this in about a week from now. AMH, thank you. Dan in Washington, good to have you back. Those debates, the first debate for Republicans taking place a week today, hosted by Fox News. Look out for our coverage of that in just the next couple of days. Looking forward to it. Joining us now is BlackRock's Marilyn Watson. Marilyn, on this fixed income market, we've seen quite a move in the Treasury market. This is going to sound political. I don't mean it to be political directly to you, but ultimately, is higher Treasury supply the price we've got to pay for the kind of things the White House is talking about?
Well, so I think higher Treasury supply is, what we're seeing when, obviously the Fed is running off its balance sheet. We're seeing really the impact from the previous few years when we saw a huge amount of support in terms of buying, and that's no longer the case. It is also, of course, as you mentioned, when you look at the fiscal deficit, I think that's an increasing concern among investors. I think that is something that they're aware of. We obviously had the Fitch's change in the rating, credit rating. And so I think, supply, demand, these things have all changed dramatically in terms of the dynamics around the Treasury market and the huge amount of supply that we are seeing and the lack of demand that we're now seeing. I mean, we've seen a completely different shift in dynamics, and so it's not a surprise really that you would see yields rise.
Marilyn, could you give us some detail on that? I know you and the team have been thinking about this and working on it. We've talked a lot about supply. How have the sources of demand changed in the Treasury market?
So we did have obviously a huge source of support from the Fed, and that is no longer the case. Now they're running off their balance sheet. So that was over 50% of support for the Treasury market that's no longer there. Then when you look at pension funds, life insurers, of course the demand is still there, but I think it's probably slightly less now. We have already seen a big shift in terms of their asset allocation. And you also see, other investors such as, money market funds, and they're obviously supporting it at the front end. But really, when you look at this demand in the belly of the curve or in the long end, when you look at foreign investment demand, for example, as well, the FX hedging costs are now very, very high. So you want to see a shift in the FX hedging costs to really see those investors coming back as well, or a change in the global growth environment. So there are a lot of different factors at play, but the support that was there for the Treasury market is just not there at the moment. And also when we're in this environment where we are seeing a lot of positive data continuing to come out of the US, we've seen a lot of market commentators, reassess their view of the US economy and the trajectory, and many people are no longer, predicting a recession, and they now actually expect the economy to maybe moderate, but remain, relatively robust. And so there's no longer the supply or the demand for the supply when you're looking for, a safe haven, because, the economy is doing very well, and we're in a very, very different situation than we were 2 or 3 years ago, which was in itself unique and has created many of the factors that now contribute to this environment.
Well, let's talk about things pre-pandemic. You and I have been talking about this stuff for years, and the conversations, Marilyn, you and I used to have was that yields would stay low for longer than people thought they would. That was just the conversation that dominated things for much of the last decade. Have we truly entered this new regime where yields can stay higher for longer than people think they can?
I think yields can stay higher for longer. We've seen a huge shift in the dynamics, obviously, around inflation, which is persistently high. I mean, as you remember, when we came out of COVID, the narrative was that this is all temporary and, inflation would come down. That is not the case. And I think, we will continue to see inflation. I think we will see it moderate, and it will continue to moderate through the rest of this year. But it is going to remain higher for longer. And I think, therefore, we will see the Fed may or may not, raise rates again. But I think when they pause, rates can stay higher for longer. The fact that the economy is also in pretty good shape, the labour market remains very, very tight. I think there are a huge confluence of different factors that mean that rates can actually stay higher for longer, and we are in a different regime to the one that we were in pre-pandemic. I think we've seen a wholesale reevaluation of the environment we're in now and the global dynamics, and we're seeing a lot of factors that contribute to that, including deglobalization, including ongoing geopolitical shifts. So I think there are a lot of different things that do contribute to that, and they're going to continue.
Marilyn Watson of BlackRock. Marilyn, thank you for the update on the Treasury market. Higher for longer, the message from Marilyn. Heard that earlier this morning from the Sovereign Wealth Fund over in Norway. The CEO, Nicolai Tangen, making the same point on a range of issues underpinning that. 22 minutes into the session, equities positive here by 0.1% on the S&P 500 with some sector price action. Here's Abby.
Driving that very small move, a wide variety of sectors. We have most sectors at this point higher, John. 8 out of 11 S&P 500 sectors are higher, led by energy, financials, staples. On bottom, it's interesting. Communication services down about 0.3%. Meta, Google, and Netflix really weighing. Discretionary and retail on the day. It's very interesting here, John, because we have so many nuances around this. Both of these sectors down ever so slightly, despite the pretty decent gains for both Target and TJX on their respective quarters. It will be interesting to see whether or not that reverses as the day goes on.
Abby, thank you. Coming up next on this program, your trading diary. attempting to avoid a second day of losses here on the S&P 500, marginally positive on the S&P. About 25 minutes in, we're up here by 0.1%. That's the price action. Let's get to the trading diary. Coming up, Fed minutes, 2 p.m. Eastern time. Then you're going to hear from the President Biden, discussing the Inflation Reduction Act from the White House at 2:30 this afternoon. Walmart reporting results ahead of the opening bell tomorrow morning. Plus, we'll get another round of jobless claims on Thursday as well. And finally, Friday, get more earnings for you from Deere and Estee Lauder, plus Eurozone CPI. From New York City, that does it for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.